All right. I think we're ready to go. So, Mr. Robot, please, let's get this thing started.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss as you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. How's everybody doing today? Let's see. Markets are, where's my charts? Wow. We are just blasting up ever since basically 10 o'clock. We are shooting right back up to where we were yesterday, and we'll see what happens. I guess, if anything, you might want to go long on the Russell here because it's breaking over this little pink line, and the other guys are blasting higher. Certainly, if the Dow gets past this red line at 26 whatever, 26.20, then this would make a good bet up from 15.85. And I hate to play bullish just for the hell of it, but you know, this morning we shorted the Nasdaq, but only made a this thing. We shorted the Nasdaq when it made its first try at 6,800, but we took the money over here, and now I'm not so enthusiastic now because everybody's, you know, flying back up. So if anything, I'd want to pick up the laggard going long, and the Russell is considerably behind the others at the moment. But, you know, again, he's got to clear 2,800 for that to be a valid play. What else is going on? Oil 64. I have two shorts on gasoline. Right about here is probably even for my two shorts. So I wrote out the spike before. Natural gas is now, this is D8. This isn't the short one. The short natural gas contracts, the regular NGs current, are 325. So the thinking is that over the course of the year, gas is going to get cheaper. I don't think so. I think it's going to be a good year for gas. So I still like the V8 contracts at 285. I think that over the course of the year, we're going to drift higher on natural gas. The dollar is getting killed again. So that's down pretty considerably. What on earth? I don't know why my other computer beeped at me. So we're probably going to test 90 again. I want to pick up some more longs at 90. You know, look, Japan doesn't like it when the dollar is weak, for one thing, and other countries don't like it either. So at some point they step in and start buying dollars, probably at this 90 line. So we'll see what happens. And again, like I said, if we're rejected here, I like this S&P short, especially if you see 68 failing and 28 failing and 1585 failing and 26,000 failing, then it makes a nice short. So we'll just keep an eye on it and see how it develops. And I certainly like gasoline short here, but the inventory report isn't until tomorrow. We have the Beige book at 2 o'clock, so we'll take a look at that and see what the Fed's saying about the general state of the economy, but I imagine everybody was in a good mood because it's the Christmas time report. So I think that everything will be very positive because we did have a good a solid Christmas quarter apparently in retail. So people have to be pleased across the board. Alrighty, so let's see. Anybody get questions about anything? I'm hearing so many noises. Oh, it's the phone. Oh, it's Tina adding things to the calendar, making weird noises, and all my devices are going off when the calendar syncs. That's what's going on. What will make the Nasdaq stop flying higher, in your opinion? Look, I wrote a good sort of summary yesterday of why I think this should be the top. Just from a value, look, I'm a valuation guy. From a valuation perspective, it should be the top. But I also have to be realistic. I lived through 1999. I lived through 2007. In 2007, oil was the thing that was out of control. Oil was $140 a barrel at the peak. The oil companies were acting as if oil was always going to be $140. And I'm just looking at the thing, saying to people, I'm like, but if oil stays at $140, which is basically almost like it's like $3.50 of the raw oil unprocessed per gallon. It says 42 gallons in a drum. So if oil's $140 a barrel and about $3.50 per gallon just in the drum, and refined, you're going to pay $4 or $5 a gallon for gasoline, and wages weren't rising. I said, this is not sustainable. You can't have a system. I mean, it's just freaking math at a certain point. You know, you can't have systems that can't exist. Okay, oil, when you're paying $100 to fill up your tank, when you go to take a 20-gallon tank of gas for $100, and that's going to go like 400 miles. So you have people who commute to work spending $100 just for the gas every week. That's an unsustainable system. It can't last. Something has to give. There's certain things you can just look at and say this can't keep happening. And Bitcoin's another one. I mean, you can't keep just allowing any coin that anyone. I mean, literally, it takes 15 minutes to build a cryptocurrency and then say, hey, I've got a cryptocurrency. It's a formula. I mean, you can jack it into a thing. I went through a process on the web to try one. It was literally like fill in the blanks, bit. How many coins do you want? How many would you like to? That's the funniest question on it when you're creating the currency. How many coins would you like to have to start with? So in other words, I say, oh, I'd like there to be 1 billion of these coins, and I'll have 900 million of them. We'll put 100 million. We'll float 100 million. See how it goes. So then everybody else has to scramble for the 100 million coins, assuming obviously I can create a demand for them. But that's ridiculous. What kind of system of money is that to go out? So you know it's not sustainable when any idiot can create a coin and come up with a catchy name. Like, you know, the guy who has Dodge coin or Doggy coin or whatever he calls it, the one with the picture of the dog on it. He did what I just said. He made it as a joke, named it Doggy coin, put a dog on the coin. Not that there's an actual coin, but he made a logo with a dog on the coin. And it's now worth $2 billion. The guy created it as a joke. Or worth. I don't know. Worth has to have big quotes around it. Everything is like that, though. There's no difference. You know, when you see Bitcoin drop 50% from the highs in a month, and you say, whoa, you know, well, we knew that wasn't worth what it said. What makes the Nasdaq worth what it says? But to that extent, though, what stops the Nasdaq from being worth another 10%, 20%? It's an arbitrary number. It's what people are willing to pay for the last transaction every day. And in some cases, like yesterday, pre-market, I was commenting that the whole thing looked kind of fake to me. and it did. It turned out we sold off everything, but now we're back. We're back because it was pre-market. Because at pre-market, when you see the futures rising pre-market like that, you say, "Wow, there's absolutely no volume behind the move." And how do the Dow went up 1% on zero volume? So how did the Dow gain, I don't know, let's say $200 billion of value when nobody actually traded it? Where'd that money come from? How is that money going to flow in? So unless $200 billion actually flows into the Dow to support it, it's going to come down. And there wasn't a lot of volume, and you can tell it was going to collapse. Today, maybe the volumes. I mean, today now you've had 2 days and people are coming back in apparently and buying like crazy. The Dow's up 240 today. So, I mean, it's not going to stop until it stops. Just like the dot-com bubble, which everybody said was ridiculous at the time, with the NASDAQ, and it went up to like, I mean, look at it now. Well, not this NASDAQ, the other NASDAQ. Wait, the NASDAQ is at 7,200. So that the NASDAQ composite, the NASDAQ, this thing tracks the 100. So the NASDAQ composite back in 2000 hit 5,000. That was insane. That was up from 3,000 the year before. It was up 60% in about a year. That is completely out of control, and the Tokyo Stock Exchange did something similar. But it wasn't that any of those companies were worth it. Yahoo was worth hundreds of billions of dollars or whatever, and it wasn't worth it actually. But that's what people were willing to pay. People were willing to pay $300 a share for Yahoo at the time. A year later, it was $20 a share, $10 a share. Which was right. It was 10 too low, it was 300 too high. That's something you settle over time, over a lot of transactions, and find people are actually willing to pay certain amounts of money. But you can't make it stop, no matter how stupid it is. Believe me, I tried. I would tell people all the time. I mean, people would ask me about the stocks in 2000, and I would say, not in 2000, 1999. And I sat out myself. I sat out basically all of 1999 because I was just like, this is just stupid. And I wasn't going to risk my perfectly good money on something so dumb, even though I knew people who were getting rich off it. But it's just like Bitcoin. Like when Bitcoin hit 20,000 was it last month no, it was a bit like a month ago. When Bitcoin hit 20,000, I picked up the phone and said to Greg, sell the Bitcoins. I'm like, I don't give a crap if they go high. We bought the stupid things for $600. We couldn't even sell them for 20,000. We ended up getting around, I'd say 18.5 average. But we also had those Bitcoin caches, which split off from Bitcoin. Those were $3,000 something or more, or $4,000. So we did end up getting like $20 something thousand back from each coin, which is insane. And what value does it really have? As we were just talking about that in the chat room, it doesn't really have any value. It's just what people are willing to pay for it. Some idiot is willing to pay $20,000 for the last Bitcoin sold on a certain day. Then that sets the price, and everybody looks at the close and says, "Whoa, $20,000." But it doesn't mean it's actually worth that. The NASDAQ, you have very few stocks driving the index. Apple is such a big percentage of the NASDAQ. What's wrong with this keyboard? That's better. So Apple is down considerably from yesterday, and it's holding if anything, it's holding the NASDAQ back. But Apple drives the NASDAQ up when it's going higher. Somebody downgraded this morning. That's what hurt it. We'll see if these tech stocks can live up to their expectations. But we already looked at XLF, and we called a short on the banking sector, XLF, using FAZ. And I think 30 was going to be the top on XLF, and I think that'll hold up. And that means the ultra short ETF, which is FAZ, down at like 10, down here around 1050. That's a nice pickup. So you can pick that up and it'll go up against the financials. But there's no way to say exactly when it's going to stop. The most likely thing to make it stop flying higher is going to be actual earnings, and people take a look and say, what the hell am I paying for? Something has to snap people out of it. I don't know what, though. I mean, people are just delusional right now. I mean, look, literally a third of the country thinks Donald Trump is a great president doing a great job and is being attacked by the left-wing media. That actually happens. So, I mean, if that's true, then you can't say anybody's going to be rational about anything for sure. There's no way to. Those people have money and they're investing in the markets. I talk to them every day. I mean, it's like I don't understand how they think at all. So, whatever is doing that, it's the same people who are spending $20,000 for a Bitcoin. They're spending some ridiculous amount for Amazon. Whatever. Oh, look at Amazon's insane too. That's another good one. Amazon, the greatest company ever, hit 1340. Well, I should have shorted. I knew it. I was like, I couldn't do it. I was just scared. I was too scared to short. That's the problem. See, like I'm a rational person, but yesterday when Amazon hit 1340, and I said that was insane, I still couldn't bring myself to bet against it because it scared the crap out of me. I mean, if 1340, why not 14? Why not 15? Why not 20? What's the difference? Well, who cares if it's 300, 400, or 500 times earnings? What difference does it make? What do we do with the fast call spread for the OP? You know what? Thank you. I thought we did a fast call spread, but I didn't put it in the OOP, and I forgot. So what is that call spread, and when did we say to do it? I will wait for that because I really wanted to know. That's something I forgot to actually officially enter it, so I have not been tracking it. So if you tell me what it is, I'll be able to tell you what we can do with it. Why isn't FAS popping higher than 11? Because XLF isn't really done going up. FAZ. Okay, so here's FAZ. Here's XLF. So you see XLF has been just sort of up and up and up, and it hasn't really, even today it's not down. It just stopped going up so much, so FAS is recovering a little bit. There's an SKF also. Oh no, it's FAS. That's another FAS. Sorry, FAS. That's a good one. FAS is the long. Now it's tempting to short FAS, but also it's just too scary because it can go the other way on you. But you could buy a put on FAS because FAS is going to come down harder than FAZ is going to go up because FAZ is only 11 and this one's 75. So a 10% move here is going to be $7. 10% move here is going to be $1. So then you have to look at the puts and calls and see what's good. But why isn't it popping? It's not popping because you gave us the 216, the February 10/11. Oh, okay, at 67 cents, and right now we're at 65. So, okay, thank you. So I'll have to find that and put it into the OOP officially. It's at 65, so it's really not off track because we're talking about February, right? These are February's. So it's got a month to go. And my theory was that the overall financials wouldn't report earnings enough to sustain where XLF, where XLF is. So my theory is that by the end of earnings into February, we should see a pullback in XLF, which will lead to FAS being over 11, which gives us the 50% gain. I still believe in that spread. Just because it didn't happen today, just because nothing immediately happened doesn't mean it's a bad call. Because the first bunch of earnings were from the big banks, from JP Morgan and Goldman Sachs, the guys who make money no matter what happens. These guys made money in the crash. There's no time when they don't make money. The question is, how do the more regional banks go? How do the local banks go? They're in that index too. All right, so what's going on now? The NASDAQ is coming. Oh, wow, the NASDAQ is considerably over. and the Dow is punching over, and the S&P is going over. So see, now is a good time to say, let's hit that that long on the Russell. Oh, it's so weird to go long on the Russell. All right, but let's give it a try and see what happens. Try there. Yep, there we go. Okay, so we got a fill. Let's see what happens. So my theory is, as long as he's over 6,800, I'll stay long here, and we'll see what happens. I want to see the Dow get over this red line. I want to see, forget coffee. We had a good one on coffee. It went to maybe 4,300 on the day. So that was pretty good, because it was down at 120 was where we get in. And it'll probably pull back again. It just keeps pulling back and going up and down, but we'll talk about that later. What am I missing? ES. All right. So I'd like to see ES get over 2,800. If ES is going over 2,800 and the Dow is popping its red line here, which is 2636, it's not there yet. And the NASDAQ, though, seems to be leading us higher right now. It's really making, see how it's making new ground? When these things turn white, it means that it's hitting a new high. Every time you see a white one come in, it means it hit a new high. It's like Trump's version of America wants to turn it all white. So that's how you can tell if something's making new highs or it isn't. So in other words, if you see 12, you know it hasn't hit that yet. And meanwhile, transactions have been going on in this range because they're all white, so they're all recent transactions. That's what the white bars tell you, that it's a recent transaction. I'm not sure what the time frame is. But anyhow, so it looks like the momentum is taking things up, but the S&P is stuck below that 28 line. The S&P is the most important index. It's got the most value. It's the widest index. It's hard to fake. So we don't take anything seriously until the S&P confirms the move up. But the NASDAQ blasted up, so it was worth taking a poke long here. So far, nothing. But we'll see what happens, because he's stuck. Now, if this guy starts failing, he starts failing, I'll take a short on the S&P, which is an easy stop over here, over 28. But these are more momentum trades. There's no conviction. There's no news really supporting this stuff. So let's see what's going on. Now, you got to always be careful, because sometimes you see this move like that. It could be a blow off top. He's stuck for sure. That's the Dow. And the S&P is stuck on their line over here. And now, by the way, being stuck at a resistance point is very understandable. Should consolidate there before it goes up. Being stuck just because it's an 00 line, this is 2800 even, it's not really a significant resistance line. So it's psychological here. So if it's sticking on a psychological line, it's never going to get over this line. If it's having trouble just getting over that line, there's no actual resistance, just the resistance of the round number. So meanwhile, we'll see what happens. Just the one contract, though, so I don't have a lot of conviction. I just want to see which way it goes. But he's still going higher. So I mean, the NASDAQ is leading us up. We'll see what happens. We haven't got that 12 yet, though. It's not getting hit. Ran into a wall there. Oh, you know what? How about I show you something else? If something isn't going the way you thought it was going, and you lose confidence, get out of the trade. So I can take this. There, done. $5. Probably cost $2 to make the trade back and forth, like $1 each time I went in and out. If it's not doing so, in other words, I thought the other guys would confirm. They're not confirming. So I'm basically, now I have a new plan. If I miss the Russell now and it moves up, I can still catch him above the 28 line and use that for a stop. So I can just switch which one I'm betting on, whichever one goes up last. But since the NASDAQ hit a brick wall here and hasn't come back over it, it's lost its momentum. So if my leading stock has lost its momentum, I'm not so inclined to jump on the trade. So at the moment, so what I thought was going to be an exciting trade turns out not to be. Just get out. The setup didn't work. You said, oh, it looks like it's going to do something. Doesn't do anything. get out. Don't sit there and ride out a trade just because you thought it would be a good idea. You know, don't you wish you could do that with a horse race, right? I mean, if you get on a horse race and you pick a horse and right out, and the gate goes and your horse is last coming out of the gate, if you could right that minute go, hey, could I have a refund? That would save you a lot of money, right? But you can do that with a futures contract. You can say, I don't like the way this is going. I just bought it. Now I don't like it. I'm going to give it back. You got to learn to cut your losses. If something isn't going, even if it's right away, you just got to say, boom, out. Take a $5 loss, take a $10 loss, take a $5 profit. Doesn't matter, but just don't do it if it's not doing what you thought. It looked like it was going to make a move up because he blasted higher, and he's still teasing over here, but he blasted higher, but these guys all got stuck. So I got no confirmation of this move. And without a confirmation, I can't make my play. You want to see a confirming move up. And if you don't see it, don't play it. All right, so I realize that I'm not teaching you guys good habits. I want to make sure you see by example, like what not to do also, because I keep leaving trades on and we go and come back and then it loses money. That's not how you do it. You got to watch these things like a hawk if you want to play them properly. And you got to guard your pennies. Make sure you don't lose anything. So here you go, 68.11, 68.11.5 could be it. If he goes over 68.12, I'm going to want to make a long bet. And try it again. But no, see, he keeps getting killed over here. Somebody's selling a lot at this level. But there's nobody's going down. These guys are still hanging at this exact spot. They're all waiting for something to happen, apparently. All right, so let's move on and do something else because it's getting boring. And how's the other stuff looking? Gasoline. So over 185, it's close to 186. It's tempting to go back in and short them again. Oh, what were we going to do? Oh, yeah. So we're talking about the portfolio. So now we have portfolios. Here's the long-term portfolio, which is up 4.8% at the moment. So it's down a bit from this morning. And of course, it's going to fluctuate. I mean, that's just a given. I was thinking about the puts. We just added, it's not up to the minute. We just added today IBM. We sold some IBM puts. But notice what we do with the puts. I'm moving the question bar. Okay, so notice what we do with these puts. On a regular basis, here we're selling 3,000, 4,000, 1,300, 7,200, 6,000, 7,500, 5,600, 4,000. Our goal is really to sell about 4,000 or 5,000 a month in short put money. And what do we do with a short put? We're promising to buy. I'm saying I will buy 1,000 shares, 10 contracts of Blackstone for $30. Blackstone is currently at 35. So I'm saying if Blackstone drops about 15%, I'm willing to buy 1,000 shares of it for $30. Now, the holder of Blackstone is paying me $4 to make that promise. Well, that drops my net from 30 to 26. So I'm only going to spend net $26,000 to buy Blackstone at 1,000 shares. That is $9, which is like 25% or more below the current price. So do I want to own it at 25% below the current price? Of course I do. So to me, this is a free $4,000. I'm happy to own it if it drops. In fact, I almost would rather it drop. I would rather have it drop so I could have a $26,000 position in Blackstone for 1,000 shares, and then I could sell puts and calls and have fun. I would rather do that than just get paid $4,000 not to own it. I almost would rather it go down than go up. Here's Alaskan Airline. Here's a Cheesecake Factory. And notice, like, they're none of them. I mean, they're not going to move much. These are 2020 plays, so there's 800 days of ownership ahead of us, or 700 and whatever. But what are there? 365 days in a year, so 730. Is that right? So about 730 days away. So there's 730 days here So it's going to take 730 days to make $3,000, which means on any given day, I should make $4. So if I'm on track, having owned this thing for oh look at that, it says 730 days right there. That's funny. Age, see, it says 730 days to go. From 1/9. So if I was on track, and today is what, the 17th. So if I was on track, I should be up about $30. I'm down 100. This is off track, but it doesn't matter this early on. Blackstone, 1/8, $4,000, should be about, say, $6 a day. So again, so figure $60, and it's up $500. So this is well ahead of schedule. But anyway, so the bottom line is minus 100 plus 575 minus 25 plus 650, 200, blah, blah, blah. So just doing this, it doesn't matter what they're up or down, but I'm just saying it's just a little incremental thing every day. It's going to drop a little cash into the portfolio every day, or a gain into the portfolio every day. Ideally, since we're buying 2 years out for the most part, we're going to, so in 2 years out, we're going to end up basically, if once a month you promise to buy something, so whatever, you know, every month when you see a bargain, you say, okay, you know what? If that gets even cheaper, I'll buy it. So something gets cheap, and you say, if it's cheaper, I'll buy it. That's what a short put is. And you get paid to promise to buy it. You know, I'm promising to buy Whirlpool, which is 170 at 130, and I'm getting paid 11, so my net's 120. 120 is $50 off. It's like a 25, 30% drop from here. So if Whirlpool gets 25 or 30% cheaper, I'll buy 500 shares. That's all this is. It doesn't seem like much, but it's 10% of our portfolio. When you do, it's very simple. It's a $500,000 portfolio, and we're selling. We don't do this in the options opportunity portfolios. We don't have that kind of margin. But in this portfolio, we have tons of extra margin. Why not use it for this? It's instead of leaving our cash laying around dormant, we take the value, the margin ability of that cash, and we promise to buy stuff that we would probably buy anyway if it went on sale. And as you can see in 8 puts that we have, it's 9 plus 13 is 22, 30, about $40,000 in just 8. Oh, well, that's right. It's an average of 5,000 each. So it's $40,000. These 8 positions right here, if they all expire worthless, will make us 10% of our entire portfolio. Just for promising to buy things that are cheap. So ideally, if we do this once a month, and you don't want to bunch them up with it, you know, we're just starting a new portfolio, so we added more, a large amount up front. But usually in the course of running a portfolio, once a month we'll add one. And then at the end of the year, obviously, there's an expiration date. Most of these expire in 2020. So after 2 years, there'll suddenly be a whole ton of these things that expire. So if you're always adding them on a regular basis and then they expire, it'll cycle through and you'll end up with maybe 24 open short items. But 24 open short items at $5,000 a piece means you collected $100,000. And if the bulk of them expire worthless, you're going to add 10% to your portfolio gains every single year just by taking your watch list items and saying, okay, if that gets cheaper, I'll buy it. So we have the Cheesecake Factory, we have Cleveland Cliffs, and Cleveland Cliffs is at $8.50, and we sold the $10 puts for $3.60. That nets in for $4.40. Not $4.40. Wait, 10 minus. I'm sorry, 6.40. Sorry, $6.40. That nets in for $6.40, which is $2 off 20. Again, 25% discount. GNC is at $3.50. We sold the $5 puts, very aggressive sale, for $3, but it still nets us in for $2. That's 1/3 off the current price. GoPro is at $6, and again, we did an aggressive sale. We sold the $8 put, but we sold it for $3.75. So our net is $4.25. That's $2 below $6. Again, 30% off. Whirlpool, like I said, 25, 30% off, and Wheaton Precious Metals, which was our stock of the year last year, we don't like it. It got a little bit high in the channel, but we said, you know what? We'll promise to buy it for $22.50 if you'll give us $4. Damn right I will. That's $18.50. I would freaking love to own this stock for $18.50. But again, it's a 20-something% discount to the current price. So all I'm doing is saying, okay, I got all this cash on the sideline. How much cash do we have on the sideline? All of it. We have like $500,000 sitting in cash. Now, part of that is because we collected $40,000 selling puts. That adds to our cash pile, right? So we have all this cash sitting around. We haven't actually, since we started with $500,000, we actually have used zero cash in the portfolio to make these positions because we have so many puts that offset the cost of everything. We're spending no money. We do have obligations to buy stuff if the market goes lower, but what's lower? When does the market ever go lower? So I mean, we'll hedge for that, but right now we haven't even had a good reason to add a hedge because the market just never stops going up. All right. ABX, thoughts on this with inflation, dividend stocks, thoughts on how they react with monetary tightening. Wow. Okay. ABX, my thoughts are, I love ABX, I love Barrick Gold. Gold is still a good inflation hedge, and frankly, I'm surprised gold isn't going up faster with Bitcoin falling apart. With cryptos freaking people out, well, it's not going to be an immediate thing, but still, you think people are going to come back to the precious metals and say, you know what, those things aren't so bad after all. I'm quite certain that the rise of cryptocurrency has been what's hurting precious metals this year. Oh, there's a dollar hitting my spot. Hang on. Look on my other computer. So I want 2 or 1. I'll take 1. No, I gotta take 2 at this price. All right, there you go. So now I added $2 longs at 90. So Bitcoin's right at 10,000 right now. Anyway, so gold has not had a big reaction to that. Gold. Here's silver. Oh, I erased gold for fast. It's up to, it's up today. It's up a little bit, but, it's trading near the highs. I think that as the shine comes off cryptocurrencies, people are going to go back to precious metals a little bit. So obviously I love ABX. I think it's an incredible value. Somebody, today they just announced, good production numbers and so on and so forth. It's great stock. And also we have the other gold stocks. We don't just have ABX. We have also CDE is the other gold, and of course Wheaton Precious Metals is gold and silver. So we have 3 ways that we're playing gold in the portfolio right now, and do we have NAK? I think we have NAK too. Oh no, only in the long-term portfolio. It's too risky for the options opportunity portfolio, but in the long-term portfolio. Oh no, this is a long-term portfolio. Oh, that's interesting. I didn't put NAK in the long-term portfolio. I'm confused. Why would I have not done that? Ooh, the options opportunity portfolio took a hit today. I wonder why. Oh, it took a big hit on TZA. NAK. Here's NAK. And that's another miner that we like. So I like it. I think the gold plays are very positive. Now, what's the other question? Dividend stocks, thoughts on how they react to monetary tightening. Well, if you're really rich, like hundreds of millions of dollars or whatever, then you want to get a return on your money. You have to put your money somewhere. So you're going to put it in the bank. You're going to put it in a T-bill. You're going to put it in a stock. But mostly, a large portion of your money, you just don't want to lose it. That's your assets. That's your stuff. You won that. You don't want it to go away. And especially now there's no estate taxes. Like, why would you not? All that money is, can be built up for hundreds of years in the future, and everybody who's got 100 million now will be a billionaire in the next 2 generations. So you certainly don't want the money. What you don't want, and any financial advisor will tell you that, is just don't lose it. 3% interest between now and your children and your grandchildren, assuming your children are young. So between now, your children and your grandchildren at 3% in 60 years, you'll have $1 billion if you have 100 million now. Just putting it away at 3%. And since 3% is 3 million a year, and they probably got plenty to live on, you don't have to worry about it. So the question then becomes, well, what's the best, safest alternative? So now you say, well, the market is okay, but it goes up and it goes down, and it pays X dividend. Now the S&P on the whole probably pays like a 2% dividend on the whole, but you can cherry pick better dividend payers than that. You were talking about dividend stocks. So the high dividend payers, it depends on which ones and how they're affected by the rates. Like REITs obviously can take the biggest hit with the higher rates. But over time, I think that's a non-issue. I think people overreact to how much REITs are affected by rates. I like it when the REITs go down, when the rates go up. So I'm like, they're not going to go up forever, and then you're going to have a nice stock on your hands. And clearly, dividend stocks outperform the market over the long haul. We just did that today. I had two charts for that today because we were talking about how dividend stocks work. Yeah, you guys should make sure you read that today because we had a big conversation about that in the post this morning. Here, look, here's dividend stocks. Well, no, that's not the one. This is the one. Okay, so from 1990, the dividend aristocrats are basically the best paying dividend stocks on the S&P. There's a list for this. You can look that up. So investing in the high dividend stocks outperform with the S&P, underperform the S&P here briefly, and then forevermore outperform the S&P going forward to the tune of 100%, double. Not 100% better, but it's 8, 14, 15, 700% better, but double basically. They outperform by double over that amount of time, and that's through 2014. There's no way anybody's ever going to be able to tell you that dividend, sticking with dividend stocks isn't better than just invest. And again, you're talking about straight up the S&P. I obviously don't advocate that, because why should you invest in crappy stocks? The high dividend paying stocks are generally good companies, like solid companies. But that includes GE, would be a dividend aristocrat, and they are no longer. They certainly are not performing. They're a drag. But the point is, you pick out the ones that you think are going to perform in the S&P. You don't just play the whole index. So it's a little misleading when they tell you that they outperform, because you're cherry picking stocks here, but not cherry picking stocks here. I'd like to, you got to play it against the S&P companies you actually would have bought in 1990 and see how those did. But either way, the point is, it's a good, safe, solid strategy. And it doesn't matter if the Fed tightens or the Fed loosens, or the Fed does this or the Fed does that. It doesn't matter. You're going to get a nice steady rate of return that is almost never worse than interest rates in the bank, and is almost never worse than T-bills. And yes, stocks can go down, but if you're a long-term investor, owning them for the long term, even at these incredible prices now, stocks continue to climb over time. Over the long term. It doesn't mean it won't go down 50% before it comes back, but 20 years from now, it'll be right back on, like this general track. So, let's say, so here's 20 years, basically. Oh, well, not here. Here's 20 years. So this is another 20 years. Let's see if we can make a line. You can't see this thing, but I can. All right. So, I can do an exact measurement. So this is 20 years. And if I move this to the end, I don't know, you guys probably can't see this box at all, but I can see it, so trust me. So now this is that same 20 years measured out. So if we extrapolate a line going out here, through the middle, out, 20 years, there you go. All right, so in 20 years, we're going to be considerably higher than we are here, up around here, way, way higher than we are in here. and you're going to collect all those dividends. That's what really adds it up, though, because while that's happening, you're going to outperform the S&P, and you're going to also, as a bonus, keep collecting these dividends that go back into either buying more stock or whatever as you go along, or obviously reinvesting it is what they measure that on. So you reinvest your dividends, buying more stock, you'll outperform by a month. It doesn't matter what the rates do. Now, will it change? Like I said, it's a factor. You have to, you have to imagine what a person with $100 million is going to do with 50 million of their dollars that they want to put somewhere safe. So what is safe? Is a T-bill safe? T-bills are actually terrible investments because when rates rise, the new bills have a higher interest rate than the old bills. And that means the old bills are worth less money. Okay, because if somebody tries to sell you a 10-year bond that has 10 years left at 4%, and somebody else has a 10-year bond with 9 years left at 2%, whose bond do you want? That's how bonds lose money. So the guy who has the 1-year-old, the guy with the 9 years left bond at 2% is going to get a very, very big discount when he tries to sell his bond compared to the guy who has the brand new 10-year bond at 4%. That's how bonds lose money. People don't understand that when they buy bonds. Bonds can lose a huge amount of money very quickly in a rising rate environment. So nobody's going to be putting money in bonds, and that's been true, obviously, it's been going on for a while. That's why one of the reasons so much money is pouring into stocks, because nobody wants to put money into bonds. I'm sorry, I say nobody. Other central banks, all the central banks are buying the bonds of all the other central banks, and that's the only reason the bond market hasn't collapsed so far. We'll see what happens when they pull back, if they really have the balls to follow through and pull back. Because I don't see where they're going to find commercial buyers for these T-bills not at these low rates. Nobody's going to want them. What was I saying? Bonds. Oh yeah, right. So bonds not safe. Can't put money there. Next, gold, silver, Bitcoin. Not that safe looking. You want to have a little bit of your money in gold and silver. But if I got $100 million, I can't really see how I could want $10 million worth of gold. That seems like a little crazy. So unless I think gold is particularly cheap, I'm not going to be putting a huge amount of my portfolio into gold. So either then equities or Bitcoin, of course. I could put my money in Bitcoin, but that's also silly unless you're a Winklevoss. It seemed to work out for them. And then you've got basically stocks. So you're left with stocks, and then you have to say, am I better off with a stock that doesn't pay me a dividend or a stock that does pay me a dividend? And if the rates are rising, it makes it worse for bonds, so more money pours out of the bond market. But the thing is now it's a trade-off, because the new money coming in has to say, okay, well, how much am I getting in dividends compared to a relatively safe 4% on a 10-year bond? But then you also have to say, do I trust the currency? Because there's a problem too. Because when you bought your dollar bonds 10 years ago, let's see. Hang on, make that smaller. So weekly dollar. Oh my God, look at this poor thing. This is bad. If it fails here, I'm going to take my loss and go home. This could really collapse. That's scary to think that could happen. Well, it wouldn't be so. All right. So, well, it depends when you did it, right? Because if you had a bond, let's say you bought a 30-year note in 2001, 2002, the dollar was 120. So your $120 at the time is now being redeemed for dollars that have a 90 buying power. So you've got a haircut. Even though you're going to get your money back, the buying power of that money has decreased by 25%. That wipes out all the interest you've been collecting. You're barely even, probably. Although maybe not, because I think bonds were probably 6-7% of the time. The people who took a 2% bond here aren't so bad because although your interest rate sucks, at least your dollar is appreciating in value. But, I mean, it's funny because we talk about Bitcoin being unstable. Look at this bullshit. Look at this, 120 to 80. So the dollar lost 1/3 of its value. So there's the dollar behaving like Bitcoin. The dollar lost 1/3 of its value, and for some reason people kept buying those. So we'll see what happens with the cryptos. But it depends. So that's the bottom line. It just depends on what the relative best place to put money is. But the dividend stocks, you got to have a longer term view of it. If you're going in with a day trading mentality, then the answer is you got to be careful. If you're going in with as an actual investor, then I would stick with the dividend stocks as a long-term good investment. We're going to talk about Ford. Yeah, that's a good idea. We will talk about Ford. Okay, we'll do that next. How confident are you that GE won't drop below 15 this year or next? How confident? I am, what is it now, 17.50? $15 for GE. What would have to happen to GE? Let's take a look. GE is currently valued at not 17.50. Close that. All right, so GE is currently valued at, that's a nice number, $150 billion. And GE is dropping $8 billion to the bottom line. So the P is a little less than 20. So you're saying, how confident am I that it won't drop $15, $250. Yeah, it won't drop $250 more down to 15. So it's not going to lose 15% of its value, or about $20 billion. If it drops to 130, see, you have to realize if it drops to $130 billion and they keep earning $8 billion, that makes their PE below 15. So I'm pretty confident that as long as they're actually earning $8-9 billion, it's highly unlikely that they're going to do that. Now, they just wrote off $6 billion. So that's not good. They were doing fine. They were dropping net income wise. Where are we? Okay, here's Q1, Q2, and Q3. So they were coming in pace for probably, what's this? 3 and 1 is not even 4, and another couple of billion here. So they were on pace for like 6 or 7 billion this year. And but now they've blown it, so now they're going to have a big zero for this year. Their earnings for this year is now going to be zero after that write-off they just took, or maybe 2 billion, something like that. So the question is, what are they going to do going forward, and how likely are they to get below? I feel they could easily pull a 15 valuation. I think they're going to make at least $4 a share. They're going to make at least $4 billion, not $4 a share. So that means that the very bare minimum would be 60 billion. That's half of where they are now. So that's like $8 or $9, let's say. So $9 would be the very lowest I could see them going, even in a catastrophic disaster. I don't think that's likely, but let's say that's the base for where they could be. I don't mind doubling down at 9. I don't mind. I would like to make GE a huge part of my portfolio at 9 because they're still the same company, and it's not the revenues that are trailing off. See, up not considerably, but up $6 billion on a quarterly basis. They're generally grinding higher, so there's not a problem with the revenues. It's a problem with the profits. And they're changing their business and selling off divisions and doing all this stuff. They're doing a lot of stuff that incurs costs that are abnormal. And what do the analysts say? And the analysts say that GE will make about $1 a share next year, and it's making $1 a share this year. So at a 15 multiple, I think that's going to hold. I think 15 will hold. I don't see them going much below it as long as they can actually pull in $1 a share. Only if that gets worse and the outlook gets worse. But of course, if the market could crash and bring it down. But even so, I'm saying 9 is like the real floor for these guys. Now, that depends on how you look at that. Because to me, if it's 9 and I have the stock at, if I'm in at 15, where's our GE play? We are in GE for, well, we're not in GE. We have the bull call spread, the 1825 bull call spread, and the 10 short puts, and they're showing a loss right now too. So we're in GE for where we expect it to be over 18 in 2020 and up to 25. We may adjust the spread down the road, but we're in at 10. We're not in at 15. So if it's at 15, well, we got the puts. But if this spread is at 15, then this is worth $10,000, and these guys are minus $5,000. So we'd be plus $5,000 on this spread. And it started off as a net cost of $700. So we would make $4,300. Oh, I'm sorry, that's not a 10. That's an 18. Sorry. No, we make nothing. I'm sorry, we make 0 here. Sorry, we'd be minus 5,000. So we would lose we would be down $5,700 if GE's at 15. All right, so that's what we're looking at on the spread that we have now. So the thing is, though, if GE was at 15, then I'm sorry, I was ahead of myself. Then I would roll this to the 10s and spend some money, whatever it cost. I would roll that to the 10s and set up a $10, 1018 or whatever spread further down the road, and then we'd be making $5,000 at 15. So I get the money back and then probably double down so that we make another $10,000. So, and that's the thing, you have to realize, this costs us $700 in cash and very little margin to make this trade. If it doesn't make any money in the next 2 years, we don't care. And we'll happily spend another $5,000 to reposition it, because the payoff would be $10,000 if we're successful. So it ties up no money. It returns, if it's successful, it returns a $14,000 if it works out. And if it doesn't work out, then we can just make the trade again, add a few $1,000s into the trade, make the trade again and run it. So since I don't think it's going to go below 15, I'm perfectly happy with the trade as it's set up. So I'm fairly confident, but I certainly wouldn't say it can't do that. I wouldn't go betting my life on it or anything like that. If the market crashes, it'll go down with the market. And like I said, it could go down to 9. But if it goes down to 9, I'm going to be thrilled to take our $700 play and turn it into a $7,000 play, where we're going to have 50 GE spreads that say it'll be over 10 in 2 more years. That's the thing. If you move into a position properly, the dropping isn't an issue. That's what we're trying to teach you how to do. I don't care if GE drops to $9 with this spread, because if GE drops to $9, let's say even if this expired completely worthless, don't forget we spent $700 to start. The only thing we have to worry about is that we're going to be assigned, or we'll own 1,000 shares of GE at 20. So obviously we'll be down $11,000. But freaking GE's at $9,000. So even if it was a worst case scenario and we're down 11,000 plus the 700 we put in the beginning, so we're down $11,700, we have an opportunity to then buy 40 GE, $5, $12 bull call spreads for some tiny amount of money, and those are going to pay us 7 times 4 is 20. They'll pay us $28,000 if GE gets back to 12. And then if you ask me how confident am I about that, I'd say I am 99% confident GE would get back to 12 at some point. So you see, it's like, why would I worry about where it is now? I hope it goes that low. I hope instead of making $14,000, I can make $28,000 because it goes lower. Because I got no problem at all buying the 512 spread and spending a good amount of money on that. I'll get my $11,000 loss back, and I'll still have $30-something thousand of profit. So for me, please let GE drop 50% rather than go up. Because if it goes up, I'm only going to make $14,000. And I think that's an important thing you guys got to understand about these trades. It's like these are, we make a nice little bit of money if it goes up, but if it goes down, we could buy more. We're not stuck. Every trade doesn't have to be profitable all the time. You let it develop and see what happens. All right. So that's enough for GE. DGD not doing well. I'm sorry. What are you talking about, Latch? DGD. What is that? Dollar General? I don't even know what that is. DGD. Digix. Oh, well, I have no clue. So sorry about your trade not doing well. Can you comment on GE thoughts? Okay, so I did that already. Existing position. It's fine. I mean, look at the long-term portfolio, or whatever this is, the options opportunity portfolio. This position is currently down $1,000. Meanwhile, the whole portfolio is still up $2,000, even though this position's down 1,000 and this one's down 1,000. This one's down more than 1,000. IMAX. So we got some clunkers here as the market's beginning to pull back a little bit. What is the market doing? Oh, as the market races to new highs, sorry. But some of our positions are not doing that good. Oh, see, I knew it. See, that's because I wasn't watching. Damn it, could have made that trade. Oh, well. All right. Beige book, IMAX. Any concerns with Jedi performance in China? No. It's not. They don't live and die by any single movie. This is the thing that you read a headline thing of IMAX, which I guess must have dumped out today. IMAX. All right, that's fine. Today. Down. Oh, it was down 1% today. You read this about IMAX, and that didn't do well. But you don't know that the heat and the fury of Wendigo, it's like some Chinese movie. That could be a blockbuster. You'll never hear boo about that. You have no idea what's going on in China. We don't know why Jedi didn't do well. We don't know that it didn't do well in IMAX. Maybe it only did well in IMAX. Maybe nobody wanted to see it unless it was in IMAX. Just because, and even if it did, there could be some Chinese movie that's doing blockbusters, and IMAX might have that. It's so, to sit there and worry about one movie up and down and this and that. You want to see how IMAX performs, and IMAX, very simply, does well. The real concern is that China has a competing system that they're trying to get into, push into more theaters and get IMAX out. That's the issue, because China's a good portion of IMAX's revenues and a good portion of what their growth potential is. But financially, revenue 290, 270, 290 to 373. That's a big jump in growth. Steady last year. This year, they're trending. That's a big quarter. So let's say this is 200, 280, 340 something. So they're probably on track they're probably kind of stable right now with the 370 whatever's. And the income is they're investing right now, which is why people don't like them, because they're spending money on stuff, so they're not going to make any money this year. But let's say they make let's say they should make $50 million at least next year, and you can buy the whole company for just over $1.3 billion. So right now the PE looks horrendous and people are scared and running out of them. But the reality is, as soon as they make $60 million, their PE is back to 20, and they look fantastic. The problem these days is that nobody wants to let anybody invest. God forbid a company says, gee, we're going to invest some money, and that's going to not show a profit, because we don't want to borrow money. We want to invest the money that we're making. See, it's a radical concept. We want to use the money that we make to invest in more stuff so that we can make more money down the road instead of going into debt. And everybody now, and investors are like, oh my God, no, you didn't make any money this year. It's like, no, we did make money, but then we used the money to do something with it and show no profit. For some reason, that's completely unacceptable. it's a weird concept. It really is. So yeah, I still like IMAX, and I still think 26 is a perfectly reasonable price. And this happens all the time. We've been investing in IMAX for many years. They go up, they go down, but they get there eventually. I mean, that's why we like them. We like them because they go down, and we get to buy them when they're low. So, I mean, first of all, it's not even, wait, daily chart, right? Oh no, that's two daily. I mean, first of all, we came in maybe at a bad time. We came in around here, I think, and it dropped since. But this is just a choppy part. We knew it was in the lower part of the channel. We wait, and if you look at it over time, it does this down and up and down and up and down and up and down and up, and then we have this nice big down, which is why we like it down here, because eventually it'll settle out back around here. Because, like I said, they make $60 million. They're cheap. So that's all they have to do is have one decent year where they get back on track, and they're going to be in good shape. And maybe it won't be the next year. That's another thing is you guys get very greedy, because if you look at this IMAX trade, we spent 36 minus 14 is 22 minus another 1,000 is $1,200. So we spent $1,200 on a $5,000 spread. So the upside on the spread is $3,800. So we make 300% on the spread by June if they hit 26 by June. They're probably not going to, but we'll see. It depends what their first quarter looks like. So we might make 300% by June if all goes well. If all doesn't go well, we're going to move the position to January, maybe spend a little bit more money, and then maybe we'll only make 200% by the end of the year. 100%. Maybe we'll have to invest a lot of money, and we're only going to make 100% by the end of the year on our new target if we roll it down. Is that a disaster? No. It's like we don't. Just because we can make, if all goes perfectly, we'll make 300%. If all doesn't go perfectly, maybe we'll only make 50% or 40% or something like that on the position. So what? And again, it's cheaper. We're not making it. We only sold 5 puts, and the puts are barely up. I mean, these puts are down $1.57. Right there. These puts are down $700. We can sell 10 of the longer puts. They're not out yet, but when the longer puts come out, we can sell 10 of them, recoup the $700, and sell maybe $2,000. We'll have a net $1,300 gain if they hold that number, which right now is 23, and maybe we'll be looking for 20 at the end of the year. So we'll make twice as much money at a lower strike, holding on to it. How is that ringing? That shouldn't be ringing. Ugh, so annoying. All right. Anyway. So this is just the first stage of a trade. And that's, in fact, this is one of the things we tried to get people to stop doing in the old portfolio, which we ran for 2 years in the original options opportunity portfolio, is to stop staring at your frickin' trade like it's a horse race. If something changes, if there's news, if there's something different about it, then you can worry about maybe adjusting and doing something. If they have earnings, and we look at the earnings, and the earnings aren't what we thought, then we might adjust it. But otherwise, you leave them alone. Stocks go up and stocks go down. These are very, very high percentage returns. Not all of them are going to work out, but the ones that do work out are going to much more than make up for the ones that don't. But you have to give them a chance. I mean, you can't be 2 weeks in, should I change my trade? That's just a crazy way to look at your portfolio. All right, anyway, Beige book, we'll look at that in a minute. IMAX. Any thoughts on REIT, specifically Omega Healthcare, trading at 9% real can be, I don't know. Okay, I haven't looked closely at Omega. To analyze a REIT is a freaking nightmare. So Omega is not one that's been on my radar. You can remind me, preferably on the weekend. I'll be very happy to look it over. But there are so many factors in a REIT. I want to know what properties they're holding, how much cash do they have, what is their loan situation, what kind of occupancy do they have on the properties now, what are they returning to investors, how much is left in the bank after they do their returns to investors. I want to see everything going on these REITs before I say, oh, it's good or bad. And I definitely want to check out their top 10 holdings of properties and see if I think those are good things to hold or not. And then you got to worry about the overall environment for healthcare. So it depends on what are they doing and what do they have? What kind of leases do they have with their people? There's so many factors. It's not an easy answer, and which is why I very rarely get into new REITs because it's such a pain in the ass. It's like I got the 3 or 4 or 5 that I like, and I'm like, oh, those are the ones I like. So unless they change, I'm happy with those. So or if I hear about one that's excellent, I might look it over. But it's so hard to add on new REITs. It doesn't matter if they have a 9% REIT yield. What matters is how solid is that and how well are they going to perform in a rising rate environment. For me, the main thing about a REIT is management team. How good is this management team at managing a changing rate environment? That's my number one concern. So I don't know what OHI looks like at the moment. OHI. Yeah, like any REIT, they're down at the moment in the lower part of their channel. This may be a great place to buy them. I mean, they've been obviously here. They found a lot of buyers here. They spiked down lower here, but they quickly got back up. So they've been pretty good at that price chart-wise. My favorite by far is NLY. And these guys are also in the lower part of their channel and also the same situation, right? They came up from here, they came up from here, and around here is where we want to actually in the long-term portfolio, we'll establish a position here if they come down around here. These guys also manage CIM, Chimera. Same people. And Chimera's in about the same place as NLY. And again, that's the story, the lowest part of the channel. So those are 2 that I'm looking to pick up. But on the week, I'm sorry, it's on the daily. On the weekly though, CIM, I was banging the table back here on CIM. It was like my favorite stock this year. Since then, they doubled. It's hard for me to get back in at this price, but I'm accepting the new value at this point. But again, NOY is a better deal to me at the moment. But this company, they've done phenomenal things with. They really have boosted this value tremendously, which is why I was screaming about this stock all this year in 2015. This was my favorite. All right, so Ford, one more thing, and then we'll get back to the Fed. So Ford is down at 12, which is where we wanted them to be. And so this is where we want to start. We want to buy them here, but we're gonna leave it because maybe they're gonna test 1150. Let's see what happens. If they go up to 1250, I don't mind. If they stay, but if they come back below, if they can hit 1150, I'll be super happy. If they go to 10, I'll be thrilled. So let's watch and see what happens because people are going to maybe downgrade them at this point, or got people who have buy ratings might take off their buy ratings on them, or people have holds might change it. So it's what we call the downgrade police. It's like when a stock fails, a lot of analysts, they start scrambling to say, oh, here's what happened and here's why we're getting out of this and whatever. They don't want to have a bum stock on their hands where they have a buy rating on Ford and hasn't done anything for them. So we let the downgrade police have a couple of days to get themselves organized, and we see what happens to them. But yeah, absolutely, I want to do Ford, and again in Ford we had I'm pretty sure, didn't I rate that up this morning? Where's Ford? Yeah, Ford was my example today. So if you want to do a Ford trade, this is where it is. But it's already below 1250. So we're just going to wait and see for the entry. But once we get the entry down, then we'll basically start initiating this kind of trade. All right, so now we can look at the Beige book. Oh, well, let's look at the stocks and see what they're doing. Oh, look at that. Damn it. I knew I should have gone long. So mad. All right, that's okay. We'll survive. Sometimes you just gotta let you go with your instincts. That's interesting. See, where's the dollar? Ooh, coming up off 90. I'm glad I bought those 2 extra calls. So that's making the Nikkei happy. I was just going to say, why is the Nikkei so happy? Because obviously the dollar's got to be going up for the Nikkei to be happy. So we held 90, which is making the Nikkei happy. Everybody's going up, which I assume means the Beige book has got some great report. You know, but why wouldn't it? Here, that's the thing. Why wouldn't the Beige book have a good report? Because it was from December, and everyone was in a good mood. So Fed Beige book. January 17, HTML. There we go. I cannot read this because I'm going to start coughing. I'm fine unless I talk a lot, which is the only time you guys ever hear me. But when I start talking a lot, my cough comes back. And I mean a lot, not like conversations, but when talking for 2 hours straight makes me cough. That's not going away, so. Let's see. Overall, 11 districts, modest to moderate gains. Dallas recording robust. See, that's good. 11 districts are having decent gains. Dallas is saying, holy crap, things are great. Outlook for 2018 is optimistic. Most districts report the non-auto retail expanded. Whoop. Residential real estate is constrained across the country. Most districts, little growth in home sales, but due to limited inventory. And I agree with that. People still aren't getting their prices. I talk to people all the time about that. You know, housing isn't coming back because people are barely getting what they paid for their house 10, 15 years ago. So there's no profit in selling the house. So why is anybody going to sell the house? There's no point. It's not. It's just you know, until housing prices go up and people actually make money on the sale, why sell? What are you doing? You know, if you have let's say you have a $500,000 house and you're paying $4,000 a month in mortgage and taxes, okay, and you owe half the money still on the house. So you got 15 years left to pay off your mortgage. Taxes aren't going away. You're still going to pay that anyway. And you're paying utilities and blah, 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 right? So if you sell your house, you're going to get $500,000, but it goes $250 if it goes back to the bank, and you've got $250. So what are you going to do? Unless even if you say, I'm going to downsize and buy a $300,000 house, what's it really going to save you? It's not going to put much money in your pocket. Your monthly will be cheaper, but you're out of pocket for moving, and you're paying the realtor fee and setting up and getting a new place and buying furniture and so on and so forth. Your first year cost is going to be probably, you know, it's going to wipe out any savings you have probably for the first year or two. Even if you drop to a $300,000 home that's almost entirely paid for by what you have, because you still have taxes. That doesn't change. You still have the utilities. You still have all that crap. You're adding moving costs, and you're adding the real estate fees and things like that. So where's the incentive for someone to move? It's very different if you have a $500,000. If you have a home you bought for $500,000, you owe $250 on it, but now you can get $650. So now the bank you'll pay off your $250 mortgage, and the bank's going to hand you $400,000, and you could buy a $300,000 home for cash and still have $100,000 sitting around that you can spend $30,000 moving expenses and crap, and then you're sitting in your new home that's got less rent. I'm sorry, you have a new home with no mortgage and lower taxes, and you have $50,000-$60,000. There's an incentive to move, right? But we're not there yet. We're only at the point where people are barely breaking even from what they bought their homes for. And people who bought their homes in the last 10 years who don't have half their home paid off, they get nothing out of moving. It's pointless. And especially when you're moving into a rising, you know, if your home is rising, then everyone's home is rising. And also, especially, so it's a certain set of situations has to occur before there's going to be any serious activity moving, and that's why, you know, housing isn't getting going. Housing gets going when wages are rising and people are making more money, and that starts pushing up the bottom of the market. As that fills up, then the other homes start getting more expensive too, and that begins a cycle where all of a sudden everybody's making money on their homes. And that's what creates real wealth for the middle class, because middle class people have most of their asset is their home. That's basically 80% of all their assets is their house. So you can't get a real recovery until that starts happening. All right, so most manufacturers report modest growth in overall business conditions. Reports indicate that some manufacturers increased, some is not good. Most districts noted growth in transportation activity. Loan volumes in many districts were steady. That's not exciting at all. Loan in many was steady. Agricultural conditions mixed. Energy described a slight uptick in activity. That's kind of, so that's it's not glowing, but it's a good report. There's not really any negatives here. It's not, again, is it the kind of report that makes you think you should be paying all-time highs for stocks? You know, and it's not. It's good, but it's not phenomenal. Employment and wages. Employment continued to grow at a modest pace, not a robust pace, but modest pace. Most districts cited tight conditions, can't find qualified workers. So businesses cannot find labor to expand. So that's not good, and was described as constraining growth. They agree with me. Several districts noted elevated demand for manufacturing and construction labor. Most districts said wages increased at a modest pace. Few districts observed that firms were raising wages in a broader range of industries. Here you go. Here's finally a little bit of wage inflation. But the problem is the Fed doesn't like wage inflation. Wage inflation is what leads to real inflation. The Fed doesn't like real inflation. Some districts reported that firms expected wages to increase in the months ahead. That's what I expect too, though. That's the number one thing that's going to improve this economy is rising wages, and it's one of the things the Fed fights against. It's so weird. Most districts reported moderate price growth. The last report, we know that. San Francisco price inflation was down. Reports of pricing pressures were mixed. Increases in manufacturing, construction, and transportation input costs. Firms and districts noted ability to increase selling prices. Okay. Some districts, some, not most, noted an ability to increase selling prices. So there's inflation creeping in the richer districts, I'm sure. Retailers in some districts reported modest price increases, and there were reports of rising home prices across the country, agriculture and energy commodities. So, you know, home prices are rising, but they're not transacting. It's like the market, right? It's not many transactions, but it goes higher. It's like Bitcoin. Can double, but nobody's actually buying them. They just have a notional value. You have to have actual transactions before it means anything. And then the breakdown. So on the whole, it's not a bad bet. It's a very good beige book. But again, not the world-beating kind of thing that makes me say, oh, quick, let me take the all-time high higher. Now, obviously, people will disagree with me because the market is blasting up. And we're hitting those highs that we hit the other day. And I can't, it's too scary to bet again, so you just got to let it go and see what happens. What I will bet against is RB. I'll take that RB short into tomorrow. So let's do that. So I'm flat. All my indexes open 0, open 0, open 0. Okay, good. So nothing's open on the indexes, so I don't want to touch those. It's too scary. It's tempting, but it's scary. Man, this is right back. See, the Dow's right back here. That was a $2,000 drop. That's pretty tempting. But you know, what's going to derail it between today and tomorrow? I don't see any particular catalyst to knock it down. That was a good beige book report. I don't see any reason why it'll fail. It might, but I mean, I don't see any particular reason that makes me dying to short it right now. Gasoline, though, just logically shouldn't be this high. So if I can get a short here, oh, come on. Seriously? Oh, there it goes. That was weird, huh? It fell, but it still filled my my short. Oh, I already had 2 shorts. Silly me. I forgot I had 2 shorts. I just wanted to add one. All right, well, whatever. So now I have 3 short at 186. Well, it's not really. Well, my PL for the day. Oh no, I'm in a profit here. So yeah, that's probably about right. So 186. So my profit is about 200 bucks. So I didn't need that extra one. But anyway, so that's my official short on gas is 186, and that one I'm happy to take in the inventories tomorrow. Oh well, let's not say that. If it drops down to 185, I'm going to take one off the table, obviously, because it's a nice profit. Because I have 3. Any questions? Let's see. Phil, my connection went down when you were discussing Ford. Just caught the end. When would you pull the trigger on the Ford? Well, we're waiting for what we call the downgrade police to have at Ford. So we're going to see what happens over the next day or two, where they stabilize. Because if you look at Ford's chart right now, Ford, that doesn't look pretty. Okay, so we'll see if they hold 12 bucks. Hopefully they don't, because we don't own them yet. So let them go to 10. I don't give a crap. I don't think it'll go that far, but I think 11, 11.50 maybe. If they get a couple of downgrades, if they don't get a couple of downgrades, when they start getting back over 12.50, we'll jump back in because I think that's a good spot. So anything around here, I'm thrilled to pick them up. Now, if we look ahead, well, I laid out the trade, of course, this morning, but that's subject to what we actually get. Ford. So the reality of Ford at the moment, I was guessing the numbers earlier. The reality of Ford's at 12.15. I can sell the $10 puts. Now, see, that spread is no good. I want these to go to $1. And the last sale here is 77 cents. That's a bullshit sale considering how much they dropped today. These haven't moved. I would rather sell the 12s for 180 than sell the 10s for $1. It's like a waste of my time. Although it's obviously a better net because I'm netting 9 versus netting 10.20. But netting 10.20 when they were 12.50 or when they were 12.20 is not bad. There's nothing to do but wait. So we'll wait and see what happens. That's one of the reasons not to pull the trigger too early is you want to see some better option pricing. You're not going to get it on the first day on a 2-year out option. You're just not going to get that kind of change. What else do we have going on here? And the calls, the $10 calls, oh, that's good. Those are holding up okay. They're at 250. So let's say we bought it now and we sold these guys. So 12.15 minus 250 is I don't know. Oh God, 65, 11.65, and then 9.65. So we net in for 9.65, and let's say we sold the 12s for $1.80. So that's going to drop our net from 9.65 to 8.85, 7.85. So our net would be 7.85 on the ones we have, and then if we're assigned though, it would be at 12, so we'd be at 19, so we'd be just under 10 bucks a share for Ford if we got assigned. If we don't get assigned though, we'll be at what I say, 7 something, so 7.65 and called away at 10 with a pretty nice profit plus the dividends. So that's the way I would do it at the moment. But again, it's a day-to-day thing. When these numbers change, my opinion changes of where I want to be. But at this exact second, that's the trade I would set up. So there's no hurry, though. It's not going anywhere. and people people freak out because they hear, like, I write up a thing. I know I wrote up a thing on Ford today. I said, look how great this is, blah, blah, blah. Great. But you know what? If Ford somehow gets away from us, if tomorrow GM buys Ford for $15 a share and the trade is no longer valid and we can't get into it, then you go, oh, well, there'll be something else. I didn't know I was going to pick Ford. I didn't know I was going to be all excited about Ford yesterday, but they dropped $1. So I'm like excited about getting them now. GE dropped too, and I'm excited about getting. If I didn't have GE already, I'd be excited about jumping into GE. The dollar dropped to 90. I was excited about adding $2 more. I mean, you never know what's going to happen on any individual day. But you just got to play whatever, you play the hand that gets dealt. So at the moment, yeah, I like Ford, but I'm not in a hurry. There's no emergency to buy Ford. It'll be there. And if it's not there, then we'll buy something else. All right. Oh, nobody else has questions. That's fantastic. And it's only I don't know what time it is. 2:30. Good. All right. So let's just finish up and take a quick look at the portfolio. See where we are. So let's go to the LTP. It's interesting because there's not much difference between the long-term portfolio and the short-term portfolio and the options opportunity portfolio, but the options opportunity portfolio is now underperforming by a mile. Well, 3.2. It's not terrible. Now the difference is partially the options opportunity portfolio has a hedge, TZA, that the long-term portfolio doesn't. Why doesn't the long-term portfolio have a hedge? Because it has all cash. In the long-term portfolio, see this cash on hand? This thing is like written for an IRA, but you get the idea. The margin, this is real, the margin requirement is $200,000, but we have $1 million in buying power. So we have $800,000 in spare buying power in the options opportunity portfolio. In the, in the long-term portfolio, that's our hedge. The $800,000 in buying power is our hedge. If the market drops, if these positions drop 75%, we can double down and double down and double down on these positions, if we still like them, of course. So the money that we have is our hedge in this one. But in the options opportunity portfolio, we don't have that. We have 200,000 in buying power, and we've used 80,000 of it. We don't have as much spare buying power in the options opportunity portfolio, so we have to be a little bit more cautious. And because of that, we've set up, we make sure we always have a hedge. So this hedge will pay $20,000 if the market drops. But meanwhile, it's down already about $1,000, and that's taking 1% off of this number. And that's really the difference between the two portfolios. One has a hedge and one doesn't. They're the same positions. They have the same IMAX and the same others. And so the fact that we're losing on a couple, that's not relevant. And then you look at like Tenant, whatever, it's got this, some of these big gains. But it's not. It's really about the balance of the portfolio. And by the way, aside from the fact that obviously we're playing both sides, when you sell a put and you sell a call, one of them is going to lose. They can't both win. So aside from the fact that 1/3 of the options that we sell are going to lose no matter what, some of the positions are going to lose, and we don't expect them all to be winners. We want ones that perform differently under different market conditions to balance the portfolio. But the main thrust of what we're trying to do, though, is we're selling a lot of premium. Like we talked about the GE position that we're in for like $1,700, that pays, I don't know, $14,000. Wait, $700. $700 pays $14,000. We have huge leverage in these positions. Huge, massive. What's the return when it's 20 times your money back? Yeah, if you get 14,000 back on 700, you get 20 times your money back. If the position goes well. There's a lot of positions like that pay 500%, 400%, whatever. We don't need them all to work, and we don't expect them all to work because some will perform better in a certain kind of market, some perform better in another kind of market. But the gist of it is, if we're 50-50 and half work and half don't, but we make 400% on the ones that work and we lose 100% on the ones that do, we're still going to be up a couple of 100% in the end. All right, so that's not the problem. We're not worried about that. You just have to give it time. And what's the key to GE? In a trade like this, what's the key is that we sold a lot more premium than we bought. When we buy the $18 call, and obviously GE's dropped since we did it, but even today, if you buy the $18 call for $270, you're paying net $20.70 for $17 stock. So you're paying $3 in premium, roughly. All right, so that's $3 in premium. It's like 20% premium you're paying on that stock. But we're not just paying the premium. We then turn around and sell a $4 put which is a dollar something in premium. We sell this put, which is $1 in pure. I'm sorry, we sell this call, which is $1 in pure premium. So we're selling $2 of premium. So that means net on the trade, we're only paying $1 in premium. When we originally took this, it was in the money, so we weren't paying it. So there was no premium to it. Let's look at one that's more even. This guy's even. Okay. Oh, Northern Dynasty. No, that's not a good example. SunPower is even. Okay, so SunPower. SunPower is at $8.60. We buy the $7 call for $3.70. By itself, that's paying net $10.70. $10.70 is $2 more than this $8.60. It's a lot of premium, $2 in premium. But we turn around and we sell the $12 call for $2.10. So now we've sold all the premium we paid, right? We're paying net $10.70 for an $8.60 stock. We're paying $2 in premium. But here we turn around and sell $2 in premium. So now we've paid no premium at all for this stock. And then we sell a put for $2. So now we've sold $2 more premium than we've paid. So we've got, now, the one thing you know for sure in options and stocks, the only thing you know for sure in the market is for a fact, all of these premiums will go to zero on January 17th, 2020. All of them will be zero. So therefore, on this trade, I am guaranteed to have a $2 advantage. I'm going to be up $2 just on the premium that I sold. That's guaranteed. There's no way that doesn't happen. The only other thing that's a wild card now is where will the stock actually be? And will my calls be in the money or not in the money? And if my calls are in the money, every penny there in the money is a bonus. But I know for a fact I get my $2. That's the advantage when you play like this. That's what we mean by being the house. Okay, I'm taking the positive side of the bet. I'm selling more premium than I'm buying, and I know that that premium gives me an advantage on every single trade I make. And that's why we only use $10,000 worth of cash, yet we're up $3,000. We're up 30% on the cash that we've deployed. And these are so far very conservative positions. And we're not doing the kind of put selling that we do in the other reason. It says two reasons the long-term portfolio is doing better. Reason number one, it doesn't have a hedge that costs us 1%. And reason number two is it does have a lot of short puts that add on that add 1% a month to the long-term portfolio's performance. So that's the reason that the long-term portfolio is up over 5%, and we're only up 3.2 in the OOP. But meanwhile, 3% is great in 2 weeks. But that's the way we set up these portfolios. There's always a positive risk-reward ratio, and all we have to do is be right half the time, and we're going to come out very well. That phone is not supposed to ring. So we looked at the LTP. What do we have here? We have Apple, a couple of short puts. We have Apple, we have GoPro. The Apple is paying for the TZA, by the way. This hedge cost $4,500, but we sold this Apple for $5,100 to pay for it. Now, obviously, Apple can go the other way, and we can lose money on the put, but in reality, I strongly believe Apple will be over 145. These will expire worthless, which means that this hedge is free. But the problem is, obviously, since it's only a April hedge, we will eventually end up spending money on it. Because we can't sell every time. We can't sell another. We can't end up selling 20 short Apple puts to pay for all of our hedges. So at some point, we will pay the piper probably. All right, we'll dig into cash at some point, but that'll be hopefully after these other positions make some money. And by the way, the only reason we're losing money on the hedge is because the other positions are making money. Okay, this loses money if the market's up. If the market's not up, if the market's not up, we make money on the hedge. If the market's up, we lose money on the hedge, but everything else we have makes money, unless we pick extremely badly. Now, speaking of dividends, Frontier still pays. I mean, unless somebody changed it, which so far I've heard nothing about it. Frontier pays a $2.40 dividend on a $7.60 stock. It is completely insane. They have not changed the dividend. We're expecting them to cut it in half. They haven't done it. It's driving us. It's weird. If they do cut the dividend, we're still going to stick with them. So we're already expecting to get hit on Frontier, but that's okay. We'll just buy a lot more. But for now, we have a position. But if that means we're going to collect a 60-cent. Imagine the 60-cent dividend. Next dividend is, well, 12/14. They just paid one. So sometime in March, they will theoretically pay a 60-cent dividend on this stock. That's going to be $900, and we're in this position for a net of, let's call that 8, and 6, 7 minus 3. Let's go about $3,000. So we're in this position for $3,000 net dollars, and we're going to collect $900, which is like 30%, in 1 quarter on the dividend. It's like the funniest stock on the planet. People think that they bought a bunch. Frontier bought all of Verizon's business, their landlines, their Fios in New York, not New York, sorry, in Florida, Texas, and California. So the biggest states in the country, not New York, except New York. But they bought in Florida, Texas, and California. They bought all of Verizon's customers. The cost of that was $8 billion or something like that. They spent some incredible amount of money. Now, wire lines, even fiber, is a dying business. You know, cord cutting. People are going Wi-Fi. The new next level Wi-Fi is coming in. That's going to be so fast that probably nobody's going to really give a damn about landlines anymore. And eventually, the phone companies will be able to beam from the towers these high-speed communications where everywhere you go in town. But meanwhile, though, anybody who's tried to use their local phone company services with the hotspots and all that crap, you know how far away we are from that being a reality. So Frontier knows this, and they're buying the customers very cheaply. And the idea is that they'll collect more money over the time of the customers staying with it. So they expect a certain attrition of customers, but meanwhile, they're collecting this gold mine of money coming in that will pay off the money that they spent for the landlines and everything else, and then they'll eventually unload it to some other customer. They'll unload it to an even lower tier customer carrier who wants to make some money down the road. But for now, it's a cash flow thing, and they're just trying to build it up. They have to now integrate it, cut costs, so on and so forth, and make it work for themselves. Also, though, Frontier is an expert at serving the underserved communities, which Verizon could care less about. So that they're looking to use the infrastructure that's there in Florida and Texas and California, which are all perfect states for Frontier because they've got tremendous infrastructure, but they completely ignore, Verizon completely ignores the unserviced area. In fact, frankly, if you're waiting for Fios like I am where I live, you know how annoying Verizon can be. They unless they see a big profit in it, they won't go to your block. And I live in a less populated spot, and they basically say, no, we're not going to run, we're not running lines. They promised us for like 10 years that they would run lines up, and they never do. Frontier, meanwhile, they play a very different game, and they will service the underserved. So they will begin adding customers in the underserved areas using the existing infrastructure and just making the last mile investments that Verizon wasn't willing to do. And by the way, Verizon does not do it because it's not profitable. Because I can tell you right now, on my block, probably 10 homes would connect to Fios for, whatever, $100 a month. So they make $1,000 a month running fiber for 10 homes. plus, there's other charges, there are other things they would sell me too, I'm sure. But let's just say it's $1,000 a month. So let's say they don't want to spend $25,000 to collect $1,000 a month because their margins are 28%, let's say, and for them to get that payback, it's going to take them 10 years before they see a payback, and it's not worth it to them. They want to see a more immediate payback for what they do. So they've got a cutoff. Verizon has a very strict cutoff and says, you know what, if we can't make 28%, we're not doing it. Whereas Frontier says, you know what, we're only going to make 15%, but 15% is plenty, and we're happy to make 15%. That's what the lower tier guys do. They make money on lower margins, and they don't. And because think about it from your perspective, $1 billion is $1 billion. You don't care if you made it. You don't care if you make $1 billion at 3% or 2% or 15%. As long as you make $1 billion, you're happy. That's the attitude Frontier has. Verizon's like, billion. It's only $1 billion, and look at all the work we have to do. It's a very different attitude. So we like Frontier for that reason. They're small, they're nimble, they have a different attitude. They're going to come in and they're going to expand the services of Verizon where they are now. All right. Meanwhile, though, they do have a stripped down service compared to Verizon, so they're going to lose customers, and that's what's killing them. Is the attrition rates people are seeing are alarming compared to Verizon or whatever. But again, you're talking about a smaller, lower cost carrier that can't afford to service the annoying, difficult to service customers. People who complain a lot, people who demand a lot are not going to be happy with Frontier. It's not that kind of company. It's a company people want cheap communications. And most people are going to stick, but the initial thing is people are going to switch when Frontier comes in. They're going to switch to AT&T. They'll switch to whatever. They'll try Sprint. They'll try other things at first. And if they like it, or they might come back, they might not. But that's where you lose it. And of course, obviously, when Frontier comes in, they get blitzed by the other phone companies, attack their customers because they say, hey, look, Frontier took over Verizon, your service is going to suck. And then anybody who has any problem with their service, they jump ship. So all this stuff is normal churn that we expect when a situation like this comes, but the investors are all bailed on it to a ridiculous extent. I mean, if we look at FTR, what is this? This is, all right, we don't need that. All right. So if you look at FTR, and again, I'm spending time on this because it's just the most amazing thing that you can get a 240 dividend on a 750 stock. That's 33% dividend on this stock. And there's no indication so far that the company's not going to keep paying it. They have the cash flow to justify it. I wish they wouldn't. I wish they'd pay off their debt faster. But they're like, why should we? We can afford this dividend. It's crazy. The stock is down from 50, 60 bucks to $7. It's down almost 90%. Because people are freaked out about how much money they borrowed. Frontier is not freaked out. They're like, we borrowed the money, we'll pay it back. They ran the model. That's what they basically think they're going to do it. They could go bankrupt. If they're wrong, they'll go bankrupt. All right? But if they're not wrong, the returns are unfreaking believable. In fact, the returns, from our perspective, if this goes well and they actually keep this dividend up, the returns for us are 100% per year. Well, more than 100% per year. At 240, we'll collect 360. We'll collect, it's 120%. We'll collect 120% a year just in the dividends. Forget whether the stock goes up or down. So if this trade goes well, we'll collect 120% a year. How much money? Now, what's our worst case scenario? Our worst case scenario is we have 3,000 shares at roughly $8 a share, maybe less than $8 a share. So if we end up with, well, it's not $8 a share. We spent 7 minus 1 minus 4 minus 5. We only spent $2. So we netted in here for $2. If we get assigned at $8, we'll average 5. So we'll end up with 3,000 shares at $5 a share, significantly lower than it is now. That's our very worst case that could happen, is we'll end up having to double down and average in at $5 a share. And that'll mean the worst case is we'll be in for $15,000. So my attitude is if they cut the dividend in half and the stock drops 50% to $3 or $3.50, we'll have, and we get assigned, we'll have 3,000 shares at $15,000. it'll be at 350, so we'll be down on the stock by $1.50 times 5 is $7,500. So we'll be down $7,500 on paper. But meanwhile, if they're still paying $1 dividend, we're going to collect $3,000 back the first year. So I still want them. Not only that, though, but we would then sell more puts and calls and lower our base. So unless they actually go to zero, this is a trade I definitely want to stick with. So I love it. Okay, and it's pretty much, well, we're a little ahead on it now, but it's a good little trade. It was fantastic at these numbers. It's still good because here you're paying on the current price is 750 minus 350 is 4 minus 140 is 260. You're paying 260 a share for the stock doing it this way. And if you get called away at 8, your profit is 540. So there's, so if you get called away, you're going to make 200% plus whatever dividends. If you don't get called away and you get assigned, you're going to have the stock at $5 a share. There's still no downside to this trade. Or I'm sorry, the downside is if they don't go bankrupt, you pretty much can't lose. So I freaking love that trade. In fact, I was really tempted to go a lot higher on the number, but I wanted to be conservative and keep it in line. So I'm trying to teach people to allocate properly, not to go crazy. But in my mind, I would load up on this stuff. I mean, if I was just going with my gut, I would buy a lot more. Wow, 280? Are you kidding me? Holy crap! Ugh. See, I should have been just staring at this freaking thing, right? Look at the Nikkei. It was here. It just dropped 80 points. Wow. That's because the dollar's coming back nicely. Look at that. Good boy. All right. Wow, this market is unbelievable. So here's Barrick Gold, still about the same price we paid for it. Bed Bath & Beyond is, wow, that's a big gainer. Holy cow. Bed Bath & Beyond is way up from where we came in. Chicago Bridge and Iron, surprisingly well ahead. The core mining is up here. Wow, who's the big loser? That's costing. We got all these gainers. Who cost us all this money? Chesapeake, about even. That's still a great entry. Finster. What are these guys? They're about even, a little bit better than where we came in. GE, not so great. IMAX is one of the big losers, but as we were talking about before, we definitely still like them. All we're going to do, these are June options. We're going to roll to a lower call in January, and we'll take a better position. Eventually, they come back. It really is just dependent on if they have a good movie season or not. Northern Dynasty is we're a little bit ahead on these guys. We're waiting to sell the calls. We need to move up. We're trying to get $1 for the was it 250 calls? I forgot. NAK. I guess it was the $2 calls, was it? I don't know. We're trying to get $1 for one of these calls. I think maybe the 250s. So we need them to move up quite a bit for that to happen. Well, see the delta is 58. So that means that Northern Dynasty has, for these to go from the current 55 to $1, we need almost a $1 move in Northern. So we need to get it to 270 before we'll be able to sell these calls for $1. If it was the 250s. If it was these guys, they're at 60. They're at 60 something. And they would need a 50-cent move, the $2. I'm not sure which ones I called for. I'm sorry, I forgot, but it was in the trade, and I wouldn't change it. I think I was right when I did. I did agonize over it at the time, and I'm still agonizing over which ones to sell. But I definitely want to get at least $1 before I do anything. Where's that? Northern, and here's SunPower. I like SunPower. It's a good solar play. Also the same place as we came in. And here's THC. And that's another medium winner here. 10 Healthcare, and also very good conservative play there. At 16, we pick up the $12 calls, and we sell the $12 puts. So that's, look, considerably 25% lower. So our worst case is owning them 25% lower than they are now. I mean, guys, this isn't brain surgery. It's like my worst case when I set up the trade is that I own the stock at a 25% discount. My best case is my net 58, 65, and 95. So 95 here. My net $600, $700 trade returns $12,000 if it goes well. What is going well? Going well is up $4. Going badly is down $4. So it's a 50-50 whether it goes up or down. But if it goes down to 12, I lose nothing. So assuming the risk and reward are the same, assuming it could either go up or down $4, my risk is zero because I basically break even at $12. My reward, if it goes up though, is 10 times my money back. And that's what this is all about. We find positive risk-reward scenarios in stocks which have a good value proposition so that we feel strongly it's more likely to go up than go down. And if we're right and it does go up, we're going to make a fortune. And the rest is just waiting. That's it. And I'll do this when I do the review. I'll do the review because it's useful to know. We'll talk about how much each trade is. Like I'll say that. I'll say, look, this is a $700 trade, and we expect to get back 15 times 8 is $12,000. So we will get 12. So if all goes well, we're going to get 12,000 back, which will be an $11,000 profit on $700. So it's more than 10 times our money back. And that's what we're on track for. And when you start adding them up, when you say, look, we're going to make 11,000 here and 6,000 there and 10,000 there and blah, 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 blah. Then you say, okay, well, these trades here that we have now, these 11 spreads are aiming to make 100,000, are aiming to make, say $60,000 by the end of the, in 2 years. No, probably 100. So let's say these 11 spreads, they're probably aim to make $100,000 in 2 years. So they'll make $50,000 a year or $4,000 a month. So we know in our portfolio, if we're on track, we should be making $4,000 a month. And here we are halfway through this month. We made $3,000. But that's all we have to do. The rest is just sitting on our ass waiting for it to mature. It's not complicated. The only complication comes when you have to make the adjustments, when you have to look at your spreads and say, oh, should I adjust that? Should I adjust this one? But not after 2 weeks. Only when something really different happens that makes you say, oh, I got to reevaluate this position. But generally, just wait, because these are powerful, powerful trades that will make a fortune if it goes well. And if it doesn't go well, we have a hedge. So it's either going to go well between now and April, or we have a hedge that's going to make us some money. But unless we pick like idiots, these are basically going to move up with the market. So if the market moves up, these will move up. We'll make a good amount of money. If the market moves down, we'll get paid on our hedge, and we'll adjust these guys with the money we make from the hedge. It's just a process, but that process is going to make a ton of money. But it's boring. I'm sorry. The problem is it's such a good system that it's boring. And if it's going well, it's extremely boring, and there's nothing much to do. But this is how you want to invest for your whole life. I mean, you got a lifetime. Do other stuff with your life other than staring at the market. This is not active trading. This is very relaxing trading. We're going to build a solid portfolio that's going to return a good amount of money on a regular basis. We're well hedged, and we can ride out anything but a horrifying, disastrous crash. We can pretty much ride out in this portfolio. The only way I can really show you that, though, is we have to play it out over time. So we did it the last 2 years, but the last 2 years was no example at all because it was a ridiculously bullish market. And for the in the Phil Stockworld side, there's the options opportunity. In the Phil Stockworld side, 4 years bull market, nonstop bull market. It's hard to show you a good way to make adjustments when the market never goes down. But if the market never goes down, we were making 50% a year on the average. And that's exactly what we're aiming to do with these trades. All right, any last questions? Could you review the CMG you recommended? Did we have an official CMG trade? Certainly not in this portfolio because CMG is too big for the OOP. It's expensive, but in the long-term portfolio, I bet we have it there. What did we do? There it is. So see, at 270, this is, you can't, it's not even worth playing in the long-term in the options opportunity portfolio, because 100 times 270 is 27,000. One contract of a short put obligates you to buy $27,000 worth of Chipotle. In the options opportunity portfolio, that's going to be a quarter of your portfolio. So that's crazy. That being said, though, since we have $1 million of buying power here, we're obligating ourselves to buy $100,000 worth of CMG if it goes down. But we don't really feel it's likely, but we can afford to take that risk because of our much bigger buying power. We can't afford to take that risk and be wrong even though obviously I think it's just as unlikely that it's going to go down in either portfolio. It doesn't change how I feel about the stock. But the problem is, if I'm wrong, the long-term portfolio can deal with it, whereas, well, I mean, and by deal with it, I mean take a $10,000 loss and laugh it off and go, oh, well, that sucked. That's no big deal in a $500,000 portfolio. In the options opportunity portfolio, if we get hit for $10,000, that really sets us back. So it's not worth taking that kind of chance, and you should always be aware of that. In a smaller portfolio, you want to keep your risks at a certain size. So you won't see any huge stocks. I'm sorry, we did sell Apple puts, but Apple, I think, is so bulletproof, I can't even imagine a situation in which it's going to be below 140 bucks. So I don't consider that risky at all. CMG, I could imagine a situation where they actually fall below. And CMG's got like a PE of 30 and Apple's got a PE of 10. So it's a totally different situation. Anyhow, so the bottom line is it's too risky for the OOP. But in this portfolio, we're currently, oh wow, look at that profit already. We have the 280-310 spread, and we paid net $13,000 for that. And then we sold $17,000 worth of puts. So our net is like a $4,000 credit. So we have $4,000 credit. That's why we have so much cash in this portfolio. We have a $4,000 credit for taking the spread, and if all goes well, it's going to pay $30,000. So we're going to turn a $4,000 credit into $34,000. If Chipotle, now get this, if Chipotle's over 310, it's at 340. How's that for a nice trade? So currently, so our goal here is to make $34,000. Currently, this trade is up 5 and 6 is 11 plus the 4 in our pocket. This is up $15,000 already. Holy crap! Now, we may have to actually consider closing this trade, because it's taking up probably most of the margin in the portfolios from this trade. That's number one. Not that we need the margin, but still, it's using up. This is the major user of the margin in this portfolio. Are these puts? Number two, we've made half the possible money already, and I got to check the math, but I mean that's as far as I can tell. We made maybe a third. I think we made about a third of the money, or close to half. No, close to half. We've made almost half the money in a month, or in 2 weeks, because CMG obviously went up like crazy. CMG. Oh yeah, look at that crap! Wow. Fortunately, we bought it right here. Wow. Fortunately, it was the first trade we made. Like CMG, I was like that when I was looking at below 300. I was like, oh, we got to buy CMG below 300. So CMG was right here, and now it's up here. So it's up almost 40 bucks. That's why it's so good. So is it worth it to, now it's a different trade, because before we had a $4,000 credit to make $30,000. Now we've got $15,000 in actual money to make $15,000 more. And it's not that I don't think it's likely that we're going to make the money, but it's going to take 2 years, and we could probably make more than 100%. I know it sounds crazy to you guys who are new to this stuff, but we can probably make more than 100% with $15,000 cash. it's not necessarily the best thing we can do with $15,000 right now. You know, with nothing, with a $4,000 credit, sure, you know, it was going to be the best thing we can do. But now we got $15,000 if we cash it in, and it's like, wow, do we really need to do this? It's like, do we really want to ride this out to make the money? Now, at this particular moment, I'm thinking yes, but you know, if we get closer to the earnings, I'm going to have to start thinking about that. Do I want to risk it? And I get, you know, we have a huge margin of safety now. We're almost certainly going to make that extra 100%. But it's just so far, you know, there's so long to go, 24 months. Don't forget, we turned a $4,000 credit into $15,000 in 2 weeks. So now we got to wait 24 more months to make like not even $1,000 a month. And so certainly we can do better in that case. So that's the way you got to look at these trades. And again, there's a huge margin of safety there. I really feel confident about this trade. That's why it's such a big trade in this portfolio. Because when it was at 290, I was like, oh my God, are you kidding me? You definitely want this. But now it's half in the money already in 2 weeks. I mean, it seems like it's going to be tricky to stick with it. So maybe that was why you had that question. But it's like, yeah, it's tough when you make that much money that quickly to stick with the trade. What's the latest on the HBI trade of the year? Oh, well, we didn't get back into it, did we? It didn't pull back as far as I know. HBI. Oh, and you know what happened is my preferred trade is limited. Oh, yeah, it did come back a bit, though. Oh, I got to stop looking at those dailies. No, it's still right up there. So I'm not really into chasing it up here. I'd like it to pull back more. But HBI became the trade of the year because limited brand got away from us. And LB, that came down quite a bit. Look, it's way down below, back to 50. Now, we picked up limited down here at 40. And so 50 is a bit up. But I like limited, I think, still better than Haynes. But this, you know, what I want to do is look at the two earnings reports and see what we want to stick with. Latest HBI. On the CMJ, didn't you make 11 out of 30 on the spread, 11.5, which you're left on the short puts? Yeah, but we also had a $4,000 credit. So I'm saying we made $15,000 out of a potential 34, which is, it's not exactly half. But don't forget, we started with a $4,000 credit, and if we cash it now, we have a net positive $11,000. So therefore, we're up $15,000 out of 34. So all we can do is make another 19. And I know that's like all you can do is make another 19. I know that, you know, if we were in a hedge fund, if you take $11,000, I'm sorry, if you take $15,000 and make $19,000 in 2 years, you are the best performing hedge fund in America. So, so I know it's kind of funny to say that's all we can make, but it's like we can do better. We consistently do better than that with our plays. So it's not there yet, but it's getting to the point, and very, very quickly, 2 weeks, it's getting to the point at which we would say, definitely, if we make 75% of the money, we take it right off the table. End of story. Any thoughts on AUO? All right, I'll take a quick look. But I don't follow them closely. It's just you know, it's an odd little stock. It's not a little stock. I mean, it's a. I don't know where they're at as far as earnings and whatever. So currently they're at 457, and they are making that's $4 billion. They're making 200 million, unless anything different is happening. There's no quarterly, so I hate things that don't have quarterlies. For some reason, they're showing $1 a share here. That doesn't seem realistic at all, though. So I think you're probably seeing something that's not real. Like here, even here, they say earnings per PE ratio 3.4. They're not making $1 a share. I don't know where that's coming from. You know, these guys are making, I mean, clearly, unless there's something much weirder going on than I know about. I don't have the quarterly numbers, but they're showing 275. So let's say 300 million on a valuation of 4.2 billion. So 10, 15. So 15, the P is around 15 plus. And if it's 19 cents a share, I mean, forget it. I mean, this, look at this projection. They're showing 20 cents a share. That puts your P at 20 something in the 20s. So I don't know what's real on this stock, so I'd have to look into it. But if you ask me in the chat room, we can talk about it there. I can take a closer look because I don't know what's going on. I don't follow them closely. It's interesting, and I'd like to see why the discrepancies are so crazy. Did they really make? My question is, did they really make $1 this year? And are they really going to drop to 20 cents next year? And why is that happening? What's going on with this company? So unless we can answer all that, I wouldn't be able to tell you. All right, so now I went overtime. I went from being early to being overtime because I talked so much. All right, guys, thank you so much for showing up. I appreciate it, and we will do it again next week, okay? So take care, everybody. I'll see you back in the chat room.